take an economy that is performing very well. We've had the fastest recovery from a downturn that we've ever seen, and the fastest recovery of any nation around the globe. The unemployment rate is near a 50-year low. The economy is doing well.
I've read so many things on this, Carol. And again, thank you so much for joining us. I've read so many things on this where people say, well, it was a lot of the ease of regulations during the pandemic that helped create what we've seen with the banking crisis, et cetera. How accurate is that?
It's not accurate. I mean, certainly there was a rollback of some regulation, but the specific things that they did didn't really create this issue. And if you think about the author of this legislation, Dodd-Frank, Barney Frank, he was actually sitting on the board of one of the banks that ended up collapsing. So obviously, the guy who knows exactly what regulation is important is the one who's overseeing the collapse. I mean, at the end of the day, the macro thread that connects all of this is Fed intervention at epic proportional scales. I mean, we have never seen the level of money printing that balloons up a balance sheet to $9 trillion, the artificial suppression of interest rates for the greater part of the last 15 years. The system could not handle that. And while each of the banks had a little different flavor of how they couldn't handle that, it was the same thing. You had the manipulation, the central planning in the market, creating a scenario that created too much money and too much risk taking that wasn't natural for what the market should have been able to handle. So if you really want to focus on the crux of the issue, we need to have regulation and roll back the Fed's powers, not worry about this other regulation, which all it does is it ends up consolidating power. If you think about after the Great Recession financial crisis, when Dodd-Frank did come out, a number of community banks went away. There was less new small business formation and less small business lending because the big banks don't have the capacity to kind of deal with the smaller loans. So the big guys get bigger, the small guys get smaller, the same as it ever was, Dana.
And that doesn't make me feel any better at all. Okay, and our friend Carol Roth, you can follow her on Twitter, Carol JS Roth. Because, okay, so again, tinfoil hat, and please bear with me because this is why you're here. You're the expert on these issues. So I see this thing going in line with it. We need less federal involvement, not more federal involvement, and from the Fed, different from federal government. But I see this thing, and I know I'm probably completely just being hyperbolic about it. It says U.S. Fed to launch Fed Now, instant payment service amid fears that it could end the CBDC interest. I don't want to participate in anything like that. I'm just immediately freaked out. Why now, tinfoil hat? Why now are they announcing this when all this other stuff is happening?
The timing does seem a little like, kind of read the room, guys. And obviously, I'm very concerned about a CBDC, a central bank digital currency, which would further consolidate the control and power over our money with the Fed and the federal government as well. So that is a bad thing. The Fed Now system, I'm kind of 50-50 on. So it is an enhanced payment system. So it kind of basically, not to get wonky, but it helps with the fast settlement of payment. So if you think about people who live paycheck to paycheck, they have to go and get a payday loan because they cannot access funds immediately. They don't have enough money in the bank. Now this allows for settlement 24/7, kind of across the system, assuming that banks and financial institutions actually opt in and want to participate in it. But, it does theoretically, if it works, it ends up increasing the speed of settlement. Certainly, it does, in my opinion, create more systemic risk because what if there's fraud? Everything's a little bit more concentrated. But that was one of the big arguments for CBDC. Oh, this is an instant way to settle payments. This will make things fast, So I think from my argument, I would say, well, you have Fed Now in place. You don't need a CBDC. So the settlement side is a little bit different than the actual currency and control of the currency. Not to say that there aren't downsides and not to say that you shouldn't be a little tinfoil hatty and a bit skeptical. But I think that the argument we all now need to make and go, great, you have a very quick payment system. You don't need a CBDC to make payments instantly. So therefore, you have no need for a digital dollar. We lead the world. We have private choices. Now we have a system that supports it. We can just move on from that. But certainly, as we know, they're never going to let a good crisis go to waste. And you can't have a bank run if there are no banks, Dana.
That is true. No banks, no bank run. There you go. Works perfectly. Talking with our friend Carol Roth, who is the author of The War on Small Business, also New York Times bestselling author of The Entrepreneur Equation. So I want to switch gears. The ESG veto his first veto, Joe Biden's first veto to defend the rule on ESG investing, the environmental so stupid governance rule. We're just doing that. That works, right? What your thoughts on that? Because the way that they characterize this is though Republicans were trying to rob everyone of their 401k, rob everyone of all their savings. It was ridiculous.
Yeah, ESG is basically, if you want to think about it, it's business social credit. There is no kind of score standard that is standardized. It's whatever we think is an important thing as the elite that we want to push.
Totally arbitrary.
We're going to force the corporations to do it. And we've already seen this in Europe and, somewhat here as well, based on, we're having a natural gas crisis. Well, maybe that's, ESG for now. And, war with Ukraine. Well, maybe weapons are now ESG investments. I mean, they keep changing the goalposts and moving the goalposts and changing the definition of ESG. At the end of the day, it's very important to have a fiduciary standard for investments. Businesses, through a free market, do the things that ESG from a macro sense wants to do, right? If you're bad stewards of the environment, if you treat your employees horribly, if you do things that are, you don't have a diverse set of thoughts that kind of consider all of your customers and your true stakeholders, you're not going to do well as a business. Your customers aren't going to want to work with you. You're not going to be able to hire. So that's built into the system. But the idea that there needs to be, this standard that's set by, God knows who, the World Economic Forum, the UN, BlackRock, a bunch of accountants that can extract fees here, it actually takes the focus away from focusing on delivering to customers and shareholders, and now creates this distraction. And we're seeing the effect of this distraction to some extent in all of the issues that businesses are facing, not just in the banking industry, but more widely. So that's the fundamental issue. They're trying to get their political and social agenda installed and using your capital to do it. So it's not only taking away your freedom and choice, it's making the businesses that you invest in perform less well. And as you know, Dana, because you are endorsing it, I have a new book coming out called You Will Own Nothing, coming out in July. And this is kind of the basis of one of those You Will Own Nothing things, that they push these things and take away your wealth creation opportunities so they can grab more wealth for themselves.
I think anybody who has a bank account needs to get your book because it is insightful and simultaneously terrifying, because it's happening now, or in the beginning stages, some of this is happening now, and it's incredibly frightening. And we definitely, the week that it comes out, we definitely want to get you on and talk about that and make sure, we want to, I think everybody needs to get that book. Okay, this might be, again, hyperbole, more of a hysterical question. Kane, I know, is thinking of it. Maybe. Are we in for a market crash?
So
I asked her like a big 30,000 foot, and she, sorry, but I wonder, because I look at this and I just get, I have to admit, I have to seek out your Twitter account because you're so suppressed on Twitter to see how you're reacting to some of these headlines, to see if I should freak out.
So here's what I have to say about the market is, obviously we know the people who are connected to the financial markets are the ones that the elite want to save because they are them or their buddies and cronies. We saw that during COVID, that the very first actions that were taken to prop up the market. So, I don't necessarily see a huge thesis to put more money in the market today. I do think that we're going to end up with a perhaps deeper and broader recession, given some of the events that have happened here recently. And I do think that's going to end up having a long tail effect on the market. you never know when. But over longer periods of time, I think it's important to diversify, because in this kind of jockeying, for position in a new financial world order, they are going to work to take care of themselves. So if you try to time the market and pull your money out now, but miss the next up cycle, that affects your overall return. So I do think diversification is important. And I also think your time period is important. If you're somebody who is retiring or has a need for that capital that's in the market now, you might want to talk to your financial advisor and maybe put it into a treasury security or something that is earning 4 or 5% over shorter durations, because your time period is different. But if you have a longer term time horizon, the financial world order shift is probably going to take some time to come about, as they always do. After Bretton Woods, it took 15 years to put that into place. And with them inflating, everything, and your dollar being worth less and less, you have to keep up with that. But it is important to be diversified. It is important to have hard assets, including precious metals, including land if you can, water rights, all of those kinds of things, and just not be in any one thing. So it's a really good time to give your financial advisor a call and say, maybe the traditional portfolio allocation doesn't make sense for me going forward, and I want to take a little bit more of a conservative approach, and then have that diversification, because we just don't know how this all goes down. And by the way, the prediction is based on what's happening today, but then some genius can make another idea, like Biden could go, yeah, we're going to just turn off all gasoline, and that completely changes the dynamic. So that makes we know that where the trajectory is going, but the actual timing and the steps along the way, that's what makes it so hard to predict. Right. And if I knew that, Dana, I'd be sitting on my yacht in the Mediterranean and not chatting with you here today.
And because we're friends with her, we would also be on our yachts, because she would be giving us tips about all this stuff. So we'd call each other all from our yachts. Carol, always so good to have you. Go get her book, The War on Small Business, and You Will Own Nothing, her forthcoming latest book out soon. Carol Roth, always a pleasure. Thank you, my friend.
All right, great to chat with you. Bye.
Take care.